friends, I hope you are all doing good. Welcome back. So in our today's class, we are going to discuss the next unit which we have in A part 1. The next topic for discussion is what, sir? Unit number 15, which talks about additional taxes and credits. Additional taxes and credits. What are other types of taxes which you have to pay, and what are some other types of credits which you are going to get? Okay, very nice topic, very simple topic. Something about this we have already discussed previously, and some new things we are going to discuss in this topic. Unit number 15. What is it? What is the name of this unit, sir? Additional taxes and credit. Like always, let us first write the notes for this, and then accordingly we will see it from our institute material and complete this topic. So there are different types of additional taxes which they are going to levy. Like we studied about something called as Kiddie tax or alternate minimum tax, which I told you that we will discuss this in future, etc. So that future has come today. So we are going to discuss about those extra types of taxes which they are going to collect, and credits like foreign income tax credit. If you are paying taxes in some foreign country, then you will get benefit while paying the taxes in US, etc. So let us see what are those different points and complete discussion on this unit. Unit number 15. Okay, unit number 15. So first type of tax, additional taxes, the tax which we are going to discuss is with respect to alternative minimum tax. The name itself says what it is. The name says who am I? The name says I am alternative minimum tax. Meaning what, sir? This is the alternate amount of tax or alternate minimum amount of tax which you have to pay. Sometimes what happens is, because there are a lot of exclusions which we have, lot of benefits or credits which the lawmakers are giving, a person may take advantage of all those credits. And by taking advantage of all those credits, he may not be liable to pay any tax at all. A person may take the benefit of all the different types of credits which are there, because of which he may not have to pay any tax at all. So lawmaker says, in such scenarios, I will collect from you something called as alternate minimum tax. If you are taking lot of benefits because of which you are not liable to pay any taxes at all, then if you are not liable to pay any normal taxes, then there is an alternate minimum amount of tax which you have to pay. So to whom it is applicable, why it is applicable, we'll see one by one all the points. First, what is alternate minimum tax, sir? Alternate minimum tax, AMT, or alternative minimum tax, is a parallel tax system which is created to ensure that high income taxpayers cannot avoid paying taxes entirely, by using deductions, exclusions, and credit. So if you are a high income taxpayer, then you should not. High income taxpayer means you are a person who has huge amount of income, and you are avoiding the taxes using deductions, exclusions, and credits. To make sure that you don't avoid those taxes by using these benefits, they have introduced this system called as alternative minimum tax. So in case of alternate minimum tax, what happens is you have to pay the higher tax. You have to pay either the alternate minimum tax or the normal taxes, whichever is higher. So what do I have to do, sir? Here we need to compute alternative minimum tax, alternative minimum taxable income and pay tax which is either alternate minimum tax or your regular tax. You have to pay alternate minimum tax or your regular tax, whichever is higher. So first they are going to compute your what, sir? First they are going to compute your alternate minimum taxable income, and then what is the tax applicable on such income? What is the tax applicable on such income? It will be computed, and you have to pay whichever is higher. Whichever is higher is required to be paid by you. When is it applicable? It applies to individuals or estates and for trust if their alternate minimum taxable income exceeds the exemption limit. So if your alternate minimum taxable income exceeds certain limit, that exemption limit, then this tax is applied. This tax is payable by you. Exceeds the exemption limit. Now, what is that exemption limit or threshold exemption, sir? Exemption limit for 2024. So if you are single or if you are head of household, then the exemption limit is $85,700. Meaning now first you are supposed to compute your alternate minimum taxable income. Now if that alternate minimum taxable income for a single or head of household is more than this amount, how much? $85,700, then they will have to pay this alternate minimum tax. Similarly, the limit for married filing separately, the limit for whom, sir? Married filing separately is $66,650. How much, sir? It is $66,650. And for married filing jointly and for qualifying surviving spouse, for married filing jointly and qualifying surviving spouse, it is $1,33,300. 1,33,300. So this is the limit based on which the exemption will be given. Of course, there is also if there is a phased out scheme also applicable, which we will see. So this is exemption limit, meaning if your income, if your alternative minimum taxable income crosses that limit, which limit? These limits, then only this alternate minimum tax is applicable. Now, sir, how is this alternate minimum taxable income computed? How is this computed, sir? For computation purpose, you first start with adjusted gross income. You first have to take what, sir? Your adjusted gross income. From that, you subtract your itemized deduction. You subtract your itemized deduction. Lawmaker says we are going to give you the itemized deduction. So subtract your itemized deduction. Now whatever is left over, now there will be an amount which is left over. To that add back your preference item. Add back what, sir? Your preference item. Now the amount which you have got is called as alternative minimum taxable income. Now from this you subtract your this alternate minimum taxable income exemption. Depending upon the filing status, what is the amount of exemption which is going to be given to you, you subtract that. Depending upon what's your filing status, you subtract this. Then whatever is left over on this amount, you apply your alternate minimum tax rate. Okay, whatever tax rate is applicable, at 26% or 28%, depending upon what is applicable to you, you apply that and you pay your alternate minimum taxes. Okay. So this is how we compute the alternate minimum tax. The first tax is alternate minimum taxes. We have to compute the alternate minimum taxes using alternate minimum taxable income. First we need to compute that and apply the rate. Accordingly, we'll get alternate minimum taxes. Next is next type of tax about which we have already discussed long ago. What is the next type of tax which we have, sir? It is called as Kiddie tax. Hey, do you remember this? Kiddie tax. Kiddie tax. Kiddie tax. What is this Kiddie tax, sir? This Kiddie tax is levied on unearned income of a child. So if there is any kid who is earning any unearned income, if he is having, then on that they are taxed at the rate of the tax rate of parent is applicable to those kids. So something like this we had discussed long back. We had solved very good questions also on this. What does this Kiddie tax mean, sir? It is a tax on unearned income. It is a tax on unearned income of certain children's to prevent. Why is it levied? To prevent shifting of income from parents to kids to tax at lower rates. So why is this normally done, sir? This is normally done so that the tax can be paid at a lower rate. The tax can be paid at a lower rate. It is a type of tax which is collected on unearned income. Sir, by the way, what do you mean by unearned income? Unearned income, I'll just write. What is unearned income? The income on your investments basically is income on investments. That is your interest income or your dividend income or your capital gain income, etc. See, normally what happens is parents know they transfer whatever income they have earned. That from that income they purchase some assets. Now, if I am, say for example, I am earning some income. If I purchase an asset in my name only, then and if that asset is generating some revenue for me, it is generating some income for me, I will have to pay tax on that income also. So what normally we can do is whatever income I have earned from that, whenever I am purchasing an investment, I will purchase that investment in the name of my children's. If I purchase that investment in the name of my children, then what will happen? The income which is going to be received will be received by children's. Now, because child is going to receive the income, the child's income are taxable at a lower rate. The child's income are taxable at lower rate, and they are going to get the same exemptions which a normal individual is going to get. So many people do this to make sure that they pay lesser amount of taxes. They transfer their income, or they purchase an investment in the name of their children, so that the income will be taxable in the hands of their children at a lower rate. So lawmaker says, if you're doing such kind of activities, then I'm going to levy. I'm going to collect some extra tax from you called as kiddie tax. Called as what, sir? What type of tax? Kiddie tax. Kiddie tax will be collected. Now, what is the rate of tax? See, normally, why is this kiddie tax applicable? See, normally, child's income is taxable at either 0% or maximum is 10%. Correct? Child income are taxable at those rates. But parent income, if you're a high earner, then your income may be subject to 37% of tax. 37% of tax and all is there. Correct? So, if you're doing such kind of activity, even your child's income will be taxable at 37%, meaning it will be taxable at the rate at which parents' income is taxable. So, kiddie tax is, in simple way, is the child income will also be taxable at the rate at which the parents' income are taxable. Okay, so now the reason though you would have understood, because many families they transfer the money to child's income which is taxable at 0% or 10%, and whereas the parents' income are taxed at a higher rate of 37%, 25%, etc. So to compensate that, they will levy kiddie tax. It is applicable if unearned income. It is applicable if unearned income is more than $2,600. If it is more than 2,600, for if unearned income is more than $2,600 and if that income is earned by dependent, and the dependent is under the age of 18 years, or he is under the age of 19 years and do not provide half of support from earned income. Case number 1, if his age is less than 18, then always it is taxable. Or he is more than 18, meaning he is more than 18 and he is providing more than 50% of his self expenses, whatever support expenses is required, no, that he is providing, then it is not applicable. If he is not providing more than 50% of his support expenses, then it is applicable from his earned income, not from unearned income. From his earned income, he is not providing that. And if the child is a full-time student under 24 years and do not provide half of their support, and they are not able to provide more than half of their support. Either they are not providing at all or not providing more than half of their support. Now there are some other conditions also. What is that other condition, sir? One important condition, for levy of Kiddie tax is that at least one of the parent should be alive. At least one of the parents should be alive. No, not both the parents. At least if, both are alive, very good. If both are not alive, at least one should be alive, because the tax rate of parent will be taken. No, if the parent is only not there, how will I take the tax rate? Exemptions or threshold for 2024. What are the exemptions applicable, or what are the thresholds applicable? First, $1,300 is exempt, meaning on the first $1,300 you don't have to pay any taxes at all. Then the next $1,300 is taxable at child's rate. Is taxed at what rate, sir? Is taxed at child's rate. And the balance income which he has, more than balance income, or else income above $2,600 is taxed at. Income above this is taxed at parents' marginal rate. So whatever tax rate is applicable to parent, that rate will apply for income above $2,600. So basically this is your Kiddie tax. Now, sir, Kiddie tax is applicable only on which income, sir? Unearned income of a child. If there is any income from his investment, then only it is applicable, and that income should be more than $2,600. There is one more condition. What is that condition? That income should be more than $2,600. Sir, is there any exception, sir? Is there any cases where this will not be applicable at all? Yes, there are two exceptions. One exception is parents are only not there. Exception meaning what, sir? When will Kiddie tax not apply at all? Exception number one is if both the parents are deceased. If none of the parent is there, then lawmaker says, Maja panno. Don't do anything in your life. Enjoy. You don't have to pay any Kiddie tax. Or you are a married child filing joint return with your spouse. Or what, sir? You are married filing jointly. Or you are a married spouse filing a joint return with your spouse. Then also you don't have to pay any Kiddie tax, because anyways you are filing joint return with your spouse. You have to pay taxes on whatever income is taxable, whatever spouse income is taxable. Kiddie tax is done. Then next type of tax is called as nanny tax. Next type of tax is called as what, sir? Nanny tax. Nanny means what? Those people who work in the house, they take care of the children, etc. Correct? So household workers are called as nannies. So what US government decided was there are many household workers or household helps which people are appointed to take care of their household work, etc., or take care of their children when they are working. Now these people are not treated as employees. They are not treated as employees, though they are working under someone or for someone's family, etc. They are not treated as employees. Therefore, they don't get the benefit of social security taxes and Medicare taxes. So lawmakers over there specifically got this kind of tax. They got a tax called as nanny tax. So these household helps also can get social security taxes and Medicare taxes benefit from whatever income they are earning. So to specifically make sure that they also get the benefit which normal worker is getting, normal employee is getting, they have introduced this tax called as nanny tax. Nanny tax, also called as household employment taxes. Household employment taxes. It is a tax on wages paid to household employees. Household employees can be a nanny who takes care of children's, or house helps or housekeepers, or your driver, etc. It includes social security tax. How much is the rate of social security tax? Of 6.2%, and Medicare tax of 1.45%. It includes social security tax and Medicare taxes withholding. It includes social security tax and medical taxes withholding, comma, if wages exceed certain threshold. So meaning even the concept of TDS is applicable, withholding taxes is applicable. If the wages are increased, if the wage income is crossing certain limit, then even social security taxes and Medicaid taxes are required to be withheld by the person who is paying them the wages. It is levied so that, so what is the reason for levying this? It is levied so that domestic workers, it is levied so that domestic workers get social security or Medicare coverage and the employers properly withhold or pay taxes, and the employer also pays the taxes on that particular income. When does it apply? It applies if household employee. When is it applicable, sir? It is applicable if the household employee is a worker under the employer's control. Meaning if he's under the control of his employer, meaning how many hours he should work, what is his duty hours, what time he should come, what time he should go, if all those things, what type of work he's supposed to do, if all those are under the control of the employer, then this type of tax will be applicable. What is the threshold limit for applying this, sir? The threshold limit is $2,700 of cash wages. For 2024, it is 2,700 of cash wages. There are two exemptions which are given, meaning this tax will not apply in two scenarios. If who is taking care in two scenarios, if in the previous topic, one of the topic we studied that even your parents can take care of your children, correct? When some that is called as what, sir? Some credit, dependent care credit, etc. When you want to go and work, child and dependent care credit, when you want to go and work or you're looking for work, and if you're paying money to someone so that person can take care of your child, then that can be taken as credit by you. So just like that, they are telling exemption will be given if the wages are paid to spouse. Meaning if the wages are paid to spouse, then this nanny tax will not be applicable. Or if the wages are paid to the parents or any child in the sense your own child under the age of 21 years. Or case number 2, or you are appointing independent contractor. So, or you are appointing an independent contractor for your household helps. So you are appointing a person so that that person can send few people at your home to take care of your garden, to act as a watchman, etc. So if you're appointing some independent contractor, it is a separate. Now if you're appointing an independent contractor, that means there is a professional services which is given by him to you, and you don't have any direct control on that person. Independent contractor and the employer or worker, what is the difference? The main difference is that for a worker I have direct control, I can tell him what to do, when to do, etc. But an independent contractor, I cannot tell him. I will just tell him what to do, how to do that particular work, within what time it is required to be done. Everything will be decided by him. Then next type of credit. So additional taxes and credits. So next type of additional taxes or credit. Now we are going into credits. Okay, so taxes are mostly done. Now we are going to credits. Next type of additional credit is section 199A. Section 199A, qualified business income deduction. Qualified business income deduction. Next is called as what, sir? Qualified business income deduction. So basically, why was this introduced? I'll just give you a background. What used to happen was the tax rates for corporation was drastically reduced. Now, what is this qualified business income, sir? This business is to part 2, no, sir. Part 2 of EA talks about business, no, sir. Yes. See, in part 2, you are going to learn about different categories of business entities: a sole proprietor, a partnership, S corporation, C corporation, etc., estate, trust. We are going to learn about different types of business entities. Now, what happens over there is LLP, LLC. what happens over there is there are some business entities like partnership, like sole proprietor, etc., or S corporations, wherein they follow some concept called as pass through. They follow a concept called as what, sir? Pass through. Meaning they are also called as pass through entities, wherein what will happen is whatever income is earned by them, on that income they themselves don't have to pay the taxes. The taxes will be paid by the owners of that businesses. Sir, once again, repeat. There are certain entities, business entities, about which we are going to learn in our part 2, which follow a concept called as these are called as pass-through entities, which follow a concept called as pass-through concept, wherein the income which is earned by them will not be taxable in their hands, that will be taxable in the hands of their owner. For example, if I am a person who is a sole proprietor, and if I am having a sole proprietorship business, then whatever business income I am earning, no, on that I don't have to pay tax myself. Meaning the business does not have to pay the taxes. The tax is required to be paid by me. I'll repeat once again. Sole proprietorship concern is the business. I am the owner of that business. Now business has earned the money, but tax is required to be paid by me. Or case number 2, I am having a partnership firm which has, let us say, 3 partners. There is a partnership firm which has 3 partners having equal share profit sharing ratio. Now partnership firm has earned the income. On that income, partnership firm does not have to pay the taxes. Tax will be paid by the partners. Whatever profit or income is earned by the partnership firm, that will be divided between the partners in their profit sharing ratio, and the individual partners will have to pay the taxes on that income. So these are also called as pass-through entities. So on these pass-through entities, what happens is, because of my business I may have to pay higher amount of taxes. Because of my business I may have to pay higher amount of taxes. Lawmaker says so, I will give you benefit. Normally C corporations are there, no, for them tax rates are very less. So because for them tax rates are very less, they have given this benefit for those people or those business entities who have passed through income concept. So what is this point, sir? A deduction of up to 20% of qualified business income is allowed. A deduction of up to 20% of qualified business income is allowed for owners of pass-through entities such as sole proprietors, partnership, S corporation, etc. S corporation, etc. It is levied to ensure that tax relief to small businesses is given to small businesses as the corporate tax rate Why, sir? Because the corporate tax rate, is just 21%. because the tax rate for corporates is only 21%, but normal individuals and all, they have to pay tax rate up to 37%. So to make sure that there is a parity between them, to ensure that there is a parity between them, between corporations and those pass-through entities, they have introduced this concept of qualified business income deduction. Please note, this is a type of deduction or a credit which will be given to you. Okay. It applies to individuals, comma, estates, trust with domestic business income. With what, sir? Domestic business income. And what is the threshold limits for them? Threshold limit, if you are a married filing jointly, if your income is somewhere between for you the threshold limit is $3,83,900 to $4,83,900. If your income is somewhere between this, and for others $191,950 to $241,950. If income is below the threshold, then full deduction will be allowed. Full amount will be allowed as deduction. Now, deduction is how much, sir? Deduction will be less than or equal to 20% of taxable income. So deduction will be equal to what, sir? Whatever your taxable income is there, of that 20%. When you take taxable income, you should not take capital gain income and dividend income. You should not take these two incomes. So if you're falling within this limit, then you will get full deduction, less than 20% of your, meaning either less than or equal to 20% of your taxable income, you are going to get the deduction. How much is the actual limits, etc., we'll study from our material. Then the next point which we have is called as foreign earned income exclusion. What is the next point, sir? Foreign earned income exclusion. Foreign earned income exclusion. Now, what is this foreign earned income exclusion, sir? See, normally what happens is, normally if you remember what we have discussed in our first beginning topics, that if you are an US citizen, then on global income, or if you are an US resident, you will have to pay tax on your global income. What income earned by you all over the world, anywhere, worldwide income, you have to pay tax in US. Correct? No. Now, if you have any income earned outside US, correct, then it will be called as foreign earned income. Now, for that foreign earned income, if you have already paid the taxes in foreign countries, then that income will be excluded from your total income, from your taxable income while computing the income under US. No, sir, repeat. Normally, to give benefits to US citizens or US residents, etc., mostly US citizen, Americans, etc., they have got this a concept called as foreign earned income exclusion, wherein if a person has any earned income, not investment income, not unearned income, if he has any earned income from some foreign country, because he would have already paid the taxes over there, we don't want to tax him again over here. So for that, we are going to give this benefit. We are going to exclude his income for the purpose of computation of tax. Okay, please note, you will get confused. Right after this, we are going to discuss one more concept called as foreign tax credit. Okay, we have one more tax benefit called as foreign tax credit. Now that is foreign tax credit. If you have paid taxes in foreign country, you can subtract that as deductions. You can subtract that as tax credit. You can subtract it as tax credit, meaning from whatever tax amount is there, you can subtract the taxes which you have paid in foreign countries. But this is not that. Foreign tax credit is subtraction of tax amount paid outside India by you. Sorry, not outside India, outside US by you when you're when you are liable to pay taxes in US. So whatever taxes you are liable to pay in US, from the tax amount you are subtracting some taxes paid by you in foreign country. But here your income is only excluded. Please note, foreign tax credit is exclusion of tax. Foreign earned income exclusion is exclusion of income. Whatever income you have earned outside India, that only will be directly excluded over here. So there is a different tax credit and earned income exclusion. Foreign tax credit and foreign earned income exclusion. I hope you have understood the normal difference between this. It is a benefit by which foreign wages or foreign or self employment income earned abroad is excluded while computing taxable income. It applies only if tax home of the taxpayer is foreign country. When is it applicable? When your tax home is the country which is not US. Meaning if the tax home is foreign country, then only it is applicable. Then it is to avoid what, sir? Double taxation, and it is to support Americans working abroad. So those who are working outside their country, and to make sure that there is no double taxation happening, this benefit is given to them. Sir, how much is the exclusion which they are going to give? Maximum exclusion which they are going to give is $1,26,500 per person. How much, sir? $1,26,500. And if you're married filing, if you're a married couple and both are abroad, then $2,53,000 per person will be excluded. $2,53,000 per person will be excluded. So here for exclusion, two tests will be conducted. Test for qualifying for foreign earned income exclusion. There are two tests. One is your bona fide residence test. You should be resident of that foreign country for the full year, meaning your tax year, full tax year should be that foreign country only. And physical presence test. Physical presence test. Now, what is bona fide residence test telling? Your full tax year, should be in foreign country. And what is this point telling, sir? Physical presence test telling that out of 330 days, meaning you should be present over there for 330 days in a 12-month period. In a period of 12 months, how many months, sir? In a period of 12 months, how many days? 330 days you should have stayed over there. Then we have one more type of exclusion or deduction called as foreign housing exclusion. Foreign housing exclusion. So if you have any housing, I mean, if there is any house you have in the foreign country, then this deduction or benefit will be given if it is paid by your employer. Some small concept it is, okay. It is an extra benefit for housing cost abroad. So because you are staying over there, you will have to pay like house rent allowance which we have over here. It is an extra benefit which is given for whatever housing cost you are paying abroad. It is allowed to be excluded only if it is paid by the employer. So only if your employer is paying this, then I will allow as deduction. Only if your employer is paying this, I will allow as deduction. Please note, only if your employer is paying this, it will be allowed to be excluded. Only if the employer is paying, it is allowed for exclusion. Then the last type of benefit which we have is foreign tax credit. Now foreign tax credit and foreign earned income exclusion is completely different. As I told you, if you have paid taxes over there, from the tax which you have to pay over here, I will subtract your taxes paid by you outside the country. Whatever tax is paid by you over there, it will be subtracted. It is a credit for income tax paid to foreign country. See, the difference between this is, and that is, this is a tax credit which is given, and that is a income benefit exclusion which is given. That is only for your earned income. Here it is completely on the tax which you have paid. It is a credit for the income tax paid by you to the foreign country to avoid double taxation. So why is this normally given, sir? This is normally given so that double taxation can be avoided. It is given to ensure US citizens abroad, all the US citizens who are abroad, are not taxed twice on the same income. On the same income, you are not paying taxes 2 times. So for that reason, they are giving this particular benefit. Sir, is there any threshold exemption or limits applicable over here? Yes. What is the threshold, sir? The threshold for this is, if it is less than or equal to $300 for single, or less than equal to $600 for married filing jointly. How much is that, sir? Either it will be 300 or less than that, or for single people, and for married filing jointly it is $600 or less than that. In such case, you can claim credit directly in form 1040. So whatever taxes you have paid over there is less than or equal to $300 or $600, then you can directly, while filling your form 1040, you can pay this money. Or else what will happen, sir? Or else you will have to claim the credit, claim it using form 1116. This is the form which you have to use. If that is not available, if it is not less than that limit, then this is the form which you have to use. So basically, these are the different types of credits. We'll take a short break and complete the discussion on this on the other side of the video. So what did we discuss over here? Unit number 15 talks about additional taxes and credits. First, we studied about alternate minimum tax. This is the minimum amount of taxes which you have to pay. Why is this levied, sir? Because many people, the high income earners, they found lot of loopholes in the tax laws and make sure that they pay lesser taxes by claiming huge amount of deductions. So for this concept is introduced, wherein they will find your alternative minimum taxable income. On that they'll compute the tax, or your regular tax, whichever is higher is required to be paid by you. And then we studied about kiddie tax. Kiddie tax is when your child, when child has an unearned income. When child has what's an unearned income, on that unearned income of the child, the parent's tax rate is applied, so that the child also pays the tax at whatever the tax rate is applicable to parent. Why is this made applicable, sir? Because many parents, what they do is they make investment in the name of the child, so that they don't have to pay any taxes or pay lesser amount of taxes. Then nanny taxes or household employment or worker taxes. So here, if you have any house help which you have in your house, or nanny, etc., for them whatever wages you are paying them, no, on that this nanny tax is applicable, so that they also get the benefit of social security and Medicare benefit like other individuals. Then qualified QBI, qualified business income deduction. So this is a specific deduction given for those people, for those entities which are called as business entities, called as pass-through entities, where their income is passed through and taxed in the hands of the it is taxed in the hands of whom, sir? It is taxed in the hands of the owners of those businesses. For them this particular benefit is given. And foreign earned income exclusion, this is a benefit given wherein if you have any earned income outside India, whether it is outside US, whether it is wage income or your self-employment income outside US, you are earning in abroad, so that income will be excluded when you are computing the income in the US. Why, sir? To avoid double taxation. Similarly, we have foreign tax credit. Foreign tax credit is a specific credit which is given on whatever taxes is paid by you in the foreign country. And we have foreign housing exclusion. If your housing exclusion, so basically if you have any housing cost which is met by your employer outside in the outside country, then you will, that whatever expenses is met by the employer, that will be allowed as deduction. So this is all about the different types of points which is there in unit number 15. We are going to study this unit from our material and see what are the questions given over there and complete our discussion on this unit. Let me meet you in my next class. Till then, tada, bye bye, take care, enjoy.